Tenzin. So my name is Ian. I'm the financial program manager at Start Small, Think Big. Just want to start off mentioning that these slides we'll be going over and should be getting presented visually to you can be accessed at this bit.ly link. So it's bit.ly/SSTB cash MGMT. And so SSTB for Start Small, Think Big, cash management MG.
Got it.
Ian, we can't hear you. I think you froze.
GMT abbreviation.
Oh, no,
I
he's
pasted that. Presentation doesn't have so many. So this presentation doesn't have as many clickable links as those you might have seen on the sales tax presentation from just a couple of days ago. But some of the information might be helpful for you to see up close, and you can kind of control which slides you're looking at or what. We provide direct assistance to entrepreneurs. So we primarily work out of New York City in the Bay Area. We also recently opened a San Jose office, but we've been remote for the entirety of the pandemic and are now serving entrepreneurs in a number of other states, and really just however we can. There are some limitations there with things like legal services because each state has very different regulations. But for the most part, financial program and the market access program, which can help with marketing or sales opportunities, should be able to help anyone, at least within the country. So these free services that we provide to entrepreneurs are either provided through in-house staff like myself or pro bono volunteers from our expert industry partners. And we try to do all this one-on-one. These group sessions are great to get core content out there, but we always want to work one-on-one with clients. I think similar focus that BOC and SBA and other organizations have. We want to work with you on your specific issues. So hopefully workshops like this can be helpful to get you thinking about what you need to start working about, start thinking about. But most likely you're going to want to follow up on these issues based on your particular circumstances. So later on in the slides at the end, you'll be able to see more about eligibility. So we do only serve entrepreneurs who otherwise would not be able to afford similar services in the private market. So if you're in need, you should reach out, see if we can bring you on as a full-time client. The financial program that I work for, it really focuses on these 5 core pillars. Up at the top, you'll see the infrastructure pieces, so financial management, kind of handling money, but also talking about banking and things like sales tax. And once you have those separated and clearly identified, what's business, finances, what's personal, and so on, we can start doing bookkeeping a little more easily, and that'll generate financial statements. 2 of which we'll talk about today are your profit and loss statement and your cash flow statement. It's not going to be the bulk of this. Cash flow is kind of a broad phrase that also happens to be a very specific financial statement. So we'll be talking about the broad phrase for the entirety of this presentation, but I will at least make some mention and highlight what a typical cash flow statement looks like, how it's different than a profit and loss statement. And once you have these types of numbers about what your business is actually doing, that's when we want to start planning, right? We want to start planning either because sales have been affected by economic circumstances. Maybe you're planning for new things, whether it's different sales offerings, different sales channels, new expenses like staff or a brick and mortar location. And those might require you to start looking at different options for accessing new capital to allow you to grow a little faster or allow you to bridge potentially difficult times. So we can help discuss what those options are and how best to present yourself to lenders. So all that essentially shows the different ways that we could help someone through their businesses' financial concerns. Of course, a lot of little details are going to come up within each of those buckets, and we'll be touching on a piece of each of those today. But the core content of today's workshop, so since it was in the name of the workshop, the update on relief funds, I will just briefly touch on those things, but Elaine gave a great breakdown of that, so I don't want to spend too much time, especially since she is the one with the SBA expertise, but hopefully that can help, or at least highlight some resources that are out there, because if you're having cash flow issues, getting cash is probably an important thing to consider. But then I also want to talk about debt management, because many people may be finding that they're unable to pay their obligations. So I want to talk about some options there. There's a lot of strategy and considerations and even legal considerations that I don't want to get too into the weeds of there, but again, just kind of highlighting some options for you to think through, to be aware of different ways that other people are handling these situations. But then we've ultimately got to talk about how you can plan for your specific cash flows, and that might include the new sales we talked about, some different expense structures. To do that, we first got to look backwards. What have you already realized about your business? What can you sell? What does it cost? And then starting to implement those into a larger projections exercise, and over time, how you're going to use those projections to compare along with your actuals, right? What you're actually doing over the next couple of weeks, months, and so on. Just a quick rundown. The relief funds, again, not going to spend too much time, but PPP and EIDL are still open right now. So really, if you need funds, you should reach out to these programs and see if you're a fit. So there's also legislation in Congress right now talking about different options. None of those have been agreed to, voted on, or signed yet. But there's certainly interest in extending this assistance to small business owners, as well as unemployed and hospitals and things like that. But right now, you can still access these programs. So if you need to replace paychecks, PPP is probably a good program for you to look at. The EIDL for more general expenses, just as Elaine mentioned. And there's more time for the EIDL right now. PPP may get extended, but it's still open as we're talking late July today. SBA is also has a number of other programs, things like the Community Advantage or the Express Loan Funds. Now, they're of course overwhelmed with requests for assistance, so I can't speak to how easy it'll be for anyone to access these programs. But there are additional options out there. If for whatever reason you've been rejected by the EIDL. And I should also mention there's a lot of confusion in, let's say, how you fill out these things, like when it asks for what your revenue is and when it asks for what your cost of goods sold are. And you might end up getting rejected the first time you fill those numbers out if you made mistakes. You should definitely talk with someone like Elaine about what options there are to check up on those applications, and if you made a mistake, if there's ways for you to refill that information, or looking to other programs, right? And the one other non-SBA program worth mentioning is that New York State has, over the last month or so, has started this New York Forward Loan Fund. And this is really supposed to be focused on allowing businesses to reopen. So that kind of opens up what kind of ways you can use the funds. And it is for smaller businesses, unlike the program like Main Street Launch Program, which had a minimum $500,000. So it was really for kind of mid-sized businesses. This New York Forward loan is specifically for businesses with under 20 full-time employees. So worth reaching out to New York State if for whatever reason you've not been able to access the funds or you still have additional needs. So real quick summary of those. Again, if you are short on cash, first question might be, how can I get some extra cash? And these are some ways. All right. Really wanted to talk about debt because I know so many have obligations from before the coronavirus that have been hard for you to keep up with. And you may have either a number of different credit cards or loans or vendor debts that you owe at this point. And there's some strategy that many businesses or debtors use to kind of consider how to address the debt that they currently have. The first thing you're going to need to do, and this is with really any small business finance or any finance considerations at all, we need to make sure we fully understand what the costs of these different things are. So in the case of debt, we need to know what we're actually paying, right? You might get an interest rate spoken to you in, let's say, promotional advertisement, or when you're signing a lease, or when someone offers you some kind of loan or credit card, but it's very often not the only things you're paying for. It may involve a bunch of fees. They may show you an APR, but even an APR that gets compounded results in something later on, which is an APY, the annual percentage yield, otherwise known as your effective interest rate. Now, in traditional loans throughout the United States, there's this Clarity in Lending Act that should break down the full chart of what you're actually paying for, your actual effective interest rate over some period of time. So you should check that out, be aware of it, and make sure that you're comparing apples to apples when you are looking at which debts you want to pay down first, or which new debts to consider. You don't want to be comparing interest rate from one loan to APY from another. It may turn out that one that looked best was actually worst when you're comparing APY to APY. So even when you have these things laid out, you truly know what your most expensive debt is or your most expensive option is, you still might have a little bit of a difference in strategy around how you want to actually pay these things down. So in terms of prioritizing these pay down efforts, there's a few different ways. So the avalanche method would essentially be paying off whatever the highest cost is first, and then over time you'd have more and more of this money that you bring in or still have left over to go towards paying multiple other debts off, because after you pay the highest one off, there's more money left for you afterwards, after you pay the highest interest, the highest cost. So if you have a lot of debt with different interest rates, some much higher than others, some might just cost you, the business, more money, it may be beneficial for you to pay that most expensive one off first. The snowball method is more when you have multiple sources of debt, but all around the same rate or the same total cost. In those cases, you might just want to pay off the smallest actual loan so you can close out one of those obligations as quickly as possible before you pay off these other options. And then the snowflake method, which is if you're really struggling to make any payments at all, you just want to take all of the profits that you can, the additional money that you have to paying these down and paying off whatever you can, spreading it out as you can with each of these new periods, whether it's every week, every month. I have excess amount. This is the amount I can afford to pay off. I'm just going to pay it wherever I can. So a little less strategic. It's probably what most of us are doing without thinking about it anyway, but you might benefit from, say, either paying off that highest interest rate first or closing out some loans, focusing on later ones. Now, if you're struggling to actually pay these things off, make any payments, whether that's Snowflake or Avalanche or anything else, first thing you need to do is actually talk with the lender. Now, I have a brief discussion about what some of the dangers of not talking to the lenders are, or not meeting your obligations in these debt scenarios. But most situations can be adjusted, right? The original agreement that you have can have some changes to that. There might already be signed parts of your signed agreement that allow some different strategies and how you pay things off. So hardship is typically a phrase that you'll see within financial relationships or contracts in general, where if you meet certain conditions, that there may be some relief for you within that actual loan. Right? You need to at least talk to the lender to let them know that you're having these problems. Otherwise, they might resort to thinking that you've just blown them off, that you don't care about the consequences of the agreement. And these hardship plans might involve either lowering payments for a period of time, pushing off payments, or reducing your overall rate of, let's say, interest, which is actually very common in credit card debt. So rate reduction might seem like a kind of goal. Why can't everyone just have a lower interest rate? And for credit cards, consumer credit cards, even small business credit cards, it's absolutely worth asking them to reduce the rate. Many of these institutions have policies to essentially reduce rates under certain conditions, and you might be meeting them. They're different for each institution and each card, but worth asking about. The other one would be deferment. So this is just pushing out when you need to pay next. Many are in these discussions with their landlords right now. I can't make payment for foreseeable future. Once I am able to start working again or bringing in income, then I'll start paying back whatever it is that I owe. And so may not be ideal. It's not complete forgiveness, but it's something to ease the burden and give you more time to figure out your cash flows. So moving debt is also very possible. There's a lot of different options. So consolidating either onto one single debt scenario. So a lot of people do this with credit cards. They transfer balances that are either higher on one credit card that they've racked up a balance on, and then move multiple of those types of credit card debts over to a credit card that either has some promotional rate where there's no interest applied for some period of time, or just in general, a much lower interest rate. These are totally legitimate strategies for kind of debt management. You do need to make sure you fully understand the terms of these places where you're either moving debt to, new credit cards, new loans, or more general refinancing options. Something to look into. The last or the sub bullet point here that I wanted to mention is just kind of confusion around debt, where people think either there's a lot of misconceptions around, but the general idea of accessing new credit, having more credit made available to you, does not in and of itself hurt. So what's typically used in credit scores and credit reporting is this credit utilization rate, which would be the idea of for every $100 available to you in credit, how much do you actually use? Now, if you're using, say, every $30 out of every $100 of you're using a smaller portion of that, let's say, for example, under 30%, it might look very responsible that you've been able to manage all this debt, and even though you've had access to additional cash, you haven't needed to take it. The other thing is credit request volume, which can hurt. So if you keep asking new places for credit over a short period of time, that might hurt your credit score because it looks like you're either getting rejected a lot, or you can't manage the credit that you do have. You haven't been asking for enough when you do ask for it. Situations like coronavirus, are likely to be short-term difficulties in your credit report. They don't have to be over a long period of time. If you had 6 credit requests or credit checks in a couple month period, by the end of any effect on your score, but within that year might be impacting it a little bit. So places to look outside of your traditional big name, multinational or national Main Street banks are, for one thing, CDFI, so Community Development Financial Institution. You can find websites that have a list of these. Micro lender is another term used for assisting small businesses with capital in ways where traditional banks wouldn't. So if you have poor credit score, you don't have much credit history, these are places to go to if you know that your Main Street bank is not going to give you those options. So BOC and the SBA intermediaries typically fit into these general ideas. General idea around secured and unsecured term loans, that if you put something up for a loan, you're going to have the lender is going to see less risk in giving you money. So if you have, let's say, vehicles, property, can be easier for you to access these loans. Those would be secured loans. Unsecured loans are typically going to have higher rates because they're riskier for the person giving you money. They don't have a chance to go get that. SBA loan programs differentiate. Some are unsecured, others secured. So something to consider, what you have to offer the actual lender when trying to get additional capital. Last thing I want to mention is this merchant cash advance. So these have become really popular over the last few years. You might see it on QuickBooks or PayPal or Square. They're saying you're eligible for $10,000 of PayPal credit or something along those lines. You just want to really be careful here because it is hard to plan for your cash flow when you're having $100 sales. They're going to take $10 of that before it even hits your bank account. Now, if all you saw the week before was that you made $100 in sales, and then you go purchase something worth $95 because you're expecting $100 to come in, you may be in trouble once that deposit actually hits. So really need to be aware of these merchant cash advances. They are great access to capital pretty easily, but they can be dangerous over time. I can try. So I see someone mentioned the sound going in and out. I can try cutting off my video to save some bandwidth if this continues to be a problem. I'll hold off for now unless others have the same comment. General lines of credit would be interest only accruing as you're paying for it. Video cuts out briefly. Okay, I am going to stop my video and we'll just keep showing the screen for now. All right. So interest only accruing as you use it would be the difference between line of credit and these kind of secured or unsecured term loans, where as soon as you get the loan, interest is going to apply whether you use it or not. All right. So credit history, the effects of not paying your credit, paying back or meeting the obligations is what I want to talk about. Also, to mention right now, if you have SBA loans, I believe they're still in the period of deferring payments there. There was 6-month deferment through from back in March, so maybe coming to an end, but you should not have been having automatic withdrawals come out if you had existing loans there. And if your intermediary who you got an SBA loan from was taking automatic withdrawals, you should absolutely contact the SBA about that. So there was essentially deferment there. But soon those will come back where you'll need to be meeting these repayments obligations, just like you would through other lenders, for either private lenders or other CDFIs. The consequences of not doing so can be severe. So your personal credit is almost definitely going to be affected by your business credit. It's very rare for small businesses to be able to fully separate a personal guarantee. So that might not stop you either having poor personal credit or not much personal credit, might not stop you from being able to access a business loan, but it's still probably dependent or still probably impacting what your personal credit score is, whether you make those business credit repayments or you don't, if you default on the loans. The business credit, the one business credit scoring company or credit reporting company agency is Dun and Bradstreet. So that's where that Dunn's number comes in. The big difference between your business credit and your personal credit are trade lines, right? So if you've been paying off vendor bills on invoices where they give you 30, 60, or 90-day terms, they might be able to report that payment history on your actual employer identification number so that you can have your business credit score positively impacted, showing that you're a responsible user of credit, even though it's not the same way of, it's not like a loan, it's not like a line of credit. They've just given you these goods or services with some flexibility in when you repay them. Now, your personal credit being affected by these business loans can hurt you for the future, trying to get either other businesses off the ground, or even just trying to rent apartments or get other property or vehicles. So really worst case scenario, it's really something you want to try to avoid, is defaulting on these. They can also result in garnishment of future wages, which can be very difficult for you to plan around and again try to get life going in the right track. Or if you have existing assets right now, they may be able to seize those, especially if you had a secured loan where you put this collateral up. So before considering something like bankruptcy, first step is always trying to renegotiate. If it gets to a court, you try to negotiate with the court. And in worst case scenario, you can pay someone to try to pay these down and negotiate for you. So there are these debt restructuring firms to look at. So really want to consider bankruptcy the last option. But all of this is in the scenario where you're essentially not able to improve your business's sales and income. And that's what we want to talk about throughout the rest of this, or kind of improve your business's profit. So first thing in terms of vocabulary that I want to separate is cost of goods sold versus operating expenses, right? So these are things that you need to pay for to operate your business, as the IRS would consider. These are regular and necessary business expenses. So cost of goods sold are the things that you have to pay for every time you make a sale, otherwise known as direct costs or variable costs. These get multiplied by each sale. So if you're a cookie business, the flour and chocolate chips that go into the cookie, you've got packaging in that cookie or a sticker or label you put on it, those multiply with each sale to you. Really important to separate those costs out because they are going to occur at a different volume based on your actual sales. Those are going to occur differently than your operating expenses. These are also referred to as fixed costs or indirect costs. So these expenses are not multiplying with every new sale. They are happening whether you make 0 sales or 1,000 sales. They might be happening each month based on some subscription or contract or agreement you have, but they may also just be happening every summer, every so often, every season. They are not multiplying with each sale. So important to separate these two sections out. Giving a little more detail about the cost of goods sold, how any business might calculate these is going to depend on what they're actually selling. And so the example of that chocolate chip cookie company, if every chocolate chip cookie is $2.50, they need to know how much those ingredients actually cost per $2.50. That ultimately generates a gross profit. So you have a dollar amount here, or what's often referred to as a gross profit margin, which would be the actual percentage, right? Out of every dollar, how much goes to cost of goods sold versus how much goes to your actual profit that you can use on the rest of the business. So really important to separate these things out. This can also include direct labor or manufacturing facilities if they're done by production, right? If you're paying something monthly, it's operating expense. But if you're paying it based on how often you use it or how many units you produce, then that's going to be a direct cost of goods sold. The other types of businesses that might have difficulty when I'm talking about cost of goods sold are service-based businesses. If you're doing consulting, if you don't have a specific product that's changing hands at the end of your sale, you might not have cost of goods sold. You might not need to pay for everything every time you make a sale. What you just generally need to be asking yourself is, every time I make a sale, is the business paying for something? Because you might have things like travel. Every time I make a sale, I need to take a $10 Uber each way. So you've immediately got $20 of cost of goods sold for each unit. Maybe you're paying for gym fees to go train a client. Any number of things could be multiplying with each hour. But if you're the one doing the work and you're not on a W-2 getting some hourly wage, it's very possible that you don't have these costs of goods sold, and that's fine. You can still do your cash flow projections without cost of goods sold. But if you do have them, you need to separate. All right, so in general, this is kind of larger scope. What are the expenses we have? What can we reduce? Now, the ones that we just talked about, those costs of goods sold, are likely going to be the hardest ones to cut out. You may be able to find vendors where you can get different rates, but you may only be able to get a better rate per sale at some volume that requires a lot of cash flow to leave your business right now. You might not have that cash flow. So it's something you need to consider. There's possibility that your business could benefit from more expensive cost of goods sold now to allow you to stay open, keep bringing in revenue, spend where else you need to, even though your per unit costs are higher than what they would be if you were to buy in bulk. For many other businesses, this would be the exact opposite, right? So just need to be considering, what can I do around these costs? You're going to have a different answer for each business, but you should be identifying which ones are specific to the sales, which ones are necessary to actually stay open. So especially if you're doing e-commerce, or this is where communication comes in through your website, you're going to need to keep that website open. Absolutely, maybe ways for you to reduce these costs, whether that is you maintaining the website on a more DIY platform, rather than some of the higher cost subscriptions. It's possible, something to look into, but probably want to pay something to make sure that your customers can keep accessing you. The next grouping here of customer generating expenses, otherwise known as customer acquisition, or really your marketing expenses in general. These are going to depend. If you have a consistent funnel of spending a certain amount of money on marketing, and you know that that continues to generate customers and new sales for you, and it's an important thing to keep open. If you cut that cost and you lose those sales, it's not going to be a very productive cost cutting for you. But for many other businesses, and I would say most small businesses, you can probably look at doing this organically, right? Maybe you're making your own social media posts, maybe you're doing your own one-on-one outreach, doing demos, potentially even giving gifts out to corporations or other groups might have new sales for you. So something to separate out, which are these costs. Now this next bullet point around protection or risk reduction is really specific to each type of business. As someone who advises small businesses on their financial security, I always want to hear that someone's insured for a scenario that seems likely, but like a lawsuit or some other situation where they could lose a lot of their business or their capital. Insurance is a very helpful thing there. But for many other businesses, that you might not be at as much risk as the insurance broker who you talked to or who sold you that plan made it seem like. So it's an important thing to look back on and say, do I need all the coverage that I'm currently paying for? Are there ways for me to reduce this cost, maybe even shifting to another provider? And then lastly, again, just grouping out these costs, making sure that you're thinking of each line item in your bank account or in your bookkeeping statements for how they're actually benefiting your business and how you can potentially reduce these is around convenience or efficiency, right? So a lot of us, when we have the cash, we want to pay for, maybe it's scheduling softwares, maybe it's some kind of organizing software on our website, maybe it's even just some self-care things that benefit us personally. Really need to look at cutting these out. These are probably the ones I would say most widely can be cut because there's not an immediate direct impact on your actual sales or how much cash it's keeping in the business, typically just drawing cash out. I also mentioned the bulk purchases that we talked about up here, down there, and a convenience or, sorry, that would be tied to the efficiency of how you're spending money. But in some cases, your cash might be a little too tight for you to be planning for long-term efficiencies. So you really need to gather as much of the data as you can about what you've already done. So some sales data might be specific to, at this price point, I was able to sell this number of units, but at this different price point, I was able to sell this number of units. These are really important pieces of data that will be absolutely essential for you to be able to plan efficiently, for you to be able to identify what changes are going to result in what benefits. That gross profit model that we talked about, right, is essentially just subtracting those direct costs from the price per unit. You need to be able to compare these gross profits between different units if you have different models, and some are more expensive than others. Maybe the prices are a little bit different. You need to know, every time I sell this thing, how much profit is it generating for the rest of the business? Some models might not be worth continuing to focus on, even if they have higher sales. Right, in the case up here, there's an extra $10 gross profit per sale if these are the same cost than this one, but there's 40 more units getting sold. So in the long run, that might be a better option for them to look at. So you need to really know what the details are of your sales. If you've been using a point of sale system, if you have emails to talking about how you've made sales to customers, wherever you can gather this information, it's going to be helpful later on. What are you actually putting in? Right, so your inputs around how many hours you're spending doing production, how many hours you're spending trying to gather sales, calling up contacts, whatever it is, you want to try to tie those things to some actual output number, which is ideally sales. Inventory turnover could be another big thing for product-based businesses. You may be spending way more in inventory than you're actually selling in any period of time. So looking back over past months to identify, maybe it is half of all your purchases end up remaining as inventory, which means you can cut your inventory purchases by half, save yourself all of that extra cash flow. On the opposite end, your accounts receivable. If you are a business that issues invoices and gets paid after 30, 60, 90 days after the original sale, you want to find out on any given day how many or how much of my sales has still not yet been paid for. It's going to be really important for planning when cash is actually going to come into the business, even if you make a bunch of sales early on. So we call that days sales outstanding, daily sales outstanding, DSO. All right, now with projections, this is a very broad idea or broad exercise that could include a lot of different things. The first type of projections that we're doing with any business is just what that per unit profitability is, right, which was that chart I was showing you before with the chocolate chip cookies and the costs per cookie. You first need to make sure that you're actually making money every time you sell something. Without that, your business will never make money. So per unit or gross profitability, absolutely essential. If it's not there, then we need to look at changing prices, potentially increasing prices and seeing how many sales you can make in those situations so that you're actually bringing more money in than you're spending. But to do your full cash flow set of projections, we need to know what those operating expenses are in addition to personal expenses. If you have to draw money out of the business to pay for rent, to be able to feed yourself, to continue operating a business, we need to know what all of those numbers are. And one thing we can do when we have those numbers is just find out how many sales you're going to need to make to cover all of those costs. So if we have some total per unit profit number for any sale made, we can then have the total amount of cash outflows divided by that to see if we, in the case of, sorry, I'll jump back in here, in the case of $1.53 of gross profit every unit, that $1.53 can divide the total cash outflows. Maybe it's $2,000 you need to spend each month. And you'll find out how many $1.53s do I need to sell to be able to cover the $2,000 of outflows. The other scenarios that we talked about, I just briefly mentioned those early on, were things around new sales channels, new sales offerings. So if you're shifting from in-person sales to now e-commerce sales, these could be totally new things you're trying to sell, or just to different people in different ways. So want to lay out all of these options and see what's worth your time, either investing in new platforms, investing in new markets, whatever that is. So to just summarize what we're doing with any projections, you first need to identify what you're actually selling. What are the costs every time you sell that item, variable costs, and then what are your total outflows, right? So what else you're paying for within the business? What else do you need to draw money out for personal funds? And then for one thing, you need to see, is this even possible, right? Because if you say, okay, I just need to make 2,000 of these sales each month, is that possible for me to produce 2,000 units to sell? Maybe each unit takes 2 hours of production. Do I have 2,000 hours to produce that? If not, you got to come back and change your numbers. We might find at this point that it's not worth it continuing down this business road. Maybe you look to another option. Always really important to give yourself those clear test cases to say, this is working, this is worth it, or it's not. And then you're always going to iterate or change these, right? So you're always going to say, now I have my projections. Let me see if I can meet those goals. And when you don't, which is most likely the case, so you're going to get better and better at it over time, but early on, probably going to be off by a bit. You then come back and you adjust it, and you get closer, and you see what is what's actually going on in the business, and be better to actually make these predictions, set these goals. So do not worry that you're not able to predict the exact future right now. Again, you're going to come back to these over time. All right. So I know I mentioned in one case the raising the prices. That would be ideal.
Ian, we can't hear you. Ian?
I don't know what happened to him, Tansy.
Oh.
I have no idea.
Okay, I don't know. One sec.
Is he back? Can you relink him?
Yeah, 1 second. I'll try to find him. I just emailed him. Let's see.
Well, hopefully someone is going to return
Mhm.
the call. He was having some problems earlier because we could hardly hear him. And then he took himself off the screen altogether.
Yeah. Sorry, everyone, for the inconvenience.
Right.
He should be joining us shortly.
Yeah, I figured he should be coming back soon.
Yeah.
You have a bunch of stuff in the chat. You're going to take care of it, am I right?
Yes.
Okay. Yeah, because some people wanted some information and I want to make sure they get it.
Yeah.
Next time we're going to take a cell number or something.
Mm-hmm.
You gotta know he's not there.
Okay. 1 second.
Hold on, everyone.
Do you have his phone number?
I don't have his phone number. That's the thing. That's why I said we're gonna get his phone number the next time so that we can. Oh,
Okay.
what is this?
I'm so sorry. I
Okay.
don't know what happened to desktop. Sorry,
Yeah,
I didn't mean to interrupt you, Elaine, if you were continuing. So I'm assuming my screen is no longer showing anything. I'm happy if anyone has the slides open, happy to kind of talk through any specifics if there are questions. This really was wrapping up the general idea about cash flow and trying to separate it out from your profit and loss. Maybe the last thing I'll spend saying there is your profit and loss is supposed to show just the business activity, but business activity right now might not be showing the full picture. Like you paying off your loans, that's not going to show up as a business expense. You pulling money out of the business to pay for your personal rent, not going to show up as a business expense. Those show up on the cash flow statement. And that's why you need the full picture of what's essentially accrual accounting, your profit and loss statement and your cash flow statement. See what's really coming out of the business, even if every time you make $1,000 in sales, your expenses are only $500, might not mean you actually have cash at the end of the month. So we really need to see that full picture. Would it be maybe make sense for me to just jump into questions now that we're only a couple minutes left? Really apologize about the difficulty with that.
I think that would be a good thing. One of the things someone that wanted to know about, were you going to send those slides to them?
Yes, so I will make sure the slides are available. It is on that bit.ly link if anyone wants to click that now, bit.ly/SSTB/CASHMGMT, SSTB cash management. But I'll send those out to Tenzin and she'll include the link with your surveys.
Are there any questions from anyone? Ben? You know what? Maybe they got to be unmuted.
Might have.
Tezzy, can you unmute everyone?
I think they're unmuted. Yes, they're unmuted.
Oh, do anyone have any questions?
I have a question.
Mm-hmm.
Okay.
Can you speak a little bit more about like the sales and the surveys slide with the increased prices, like the A/B testing? Like how does that actually translate into what you're physically doing?
So it's a great question. The way that I have it listed out there, it's definitely easier if I can speak about it, is that the sales are really the only test you have. Surveys are great. Many people try to do those surveys before they issue a new product, and it might generally tell you what one pre-market product is, what the popularity is of one pre-market product to another pre-market product. But until you actually try to sell something at a new price point, you won't know how the market will respond. So you really need to just try these things out. So if you have a new price that you're considering, you need to try to test it out. The general idea with A/B testing is trying to isolate variables as much as possible. So if it is the same market, it's presented the same way, it's the same product, but test A has $10 price point and test B has a $12 price point, that's the ideal scenario you could be in, where you could really see, are people buying it at the same volume at $12 as they were at $10? Generally, the next bullet point I have under there is around price elasticity, which is typically telling us that most of our products that we try to sell, people are not going to buy at any price, that they have some limited amount of additional funds that they're not spending on rent, food, whatever else it is that they need to spend money on. So it's actually the case that the lower these prices are, the more easily they'll be able to buy them. This is a general idea of, is this price elastic? Does the demand change or when the price changes? The opposite example would be gasoline, right? If gasoline increases, people are still going to buy at the same amount. So the only considerations that I have, lowering prices is typically the strategy that anyone's going to want to look at to increase sales volume. But it could be something around your market doesn't want to pay for something at this lower price. Maybe it indicates something to them about quality. That's a little too much psychology for me to be comfortable with. But a problem there is getting so low, right? You're essentially competing around price on these products with your market competitors, that a big market competitor who maybe owns some part of the supply chain can probably beat you on that race to the bottom, right? They can probably have much lower prices, and then you're just disappearing profit margin for everyone in the market. But the bigger companies would likely be able to sustain themselves for longer than the smaller ones can. The other thing you want to consider is that issuing a discount at different seasons can be really helpful. So you want to not have to set your prices so low permanently that you can never actually offer a discount, because it would turn you to negative gross profitability. Does that?
Thank you. Yes, thank you so much.
And I do have on the following slide after that is it's a lot and can be confusing, but general idea of that you can just test out different prices, and that you want to see what would my actual break even be at this different price, right? Can I cover my costs with not that many different sales if it's a lower price? If so, then it might be worth lowering that price.
Hi, this is Jennifer. I have a couple of questions. Thanks for the great info. I have a natural skincare company, and I'm in the process of repackaging, redoing the logo, and all of that. Mm-hmm. Is that something that Start Small, Think Big would help with, or I would need to find an outside organization for that?
So the math is something that we would be able to help with. Finding your actual co-manufacturing partners, we don't have resources for right now.
No, not the manufacturing of the product, but change the packaging, changing the actual packaging that it's in.
Oh, you're thinking about the design and things like that?
Yeah.
So we do, for our market access services, do have some designers do logos and things like that. I don't know what the exact capacity around that is, but there's also a bunch of regulations that go in there. So most of the time, we're not going to source that out to volunteers. If it's just a component of your design, then we can definitely assist with. But the entire process is a little more involved than just a single designer.
Okay, thanks. Have you the philosophy behind selling something ending, just an even dollar amount, or 95 or 99?
Yeah.
What's your take on that?
To be totally frank, I think all that consumer psychology stuff is not very realistic. So I would not spend time on that. I would spend time on doing projections about it. If I have it at 95 cents, does it make a difference to have it at $1? That you want to be able to cover your costs, your needs, for as low of a profit margin as possible, so that you can generate more and more sales and get more and more customer share. Once you start getting a real sense of who it is that your customers are and clear trends around how they're buying things, then you can probably say, my customer's psychology is XYZ when I do A/B testing. But to say that there's some general, that everyone's going to respond the same way to something like a number, I don't buy much of it.
Okay, thank you. And last question, how long after we apply for Start Small, Think Big do you hear whether or not you've been accepted?
So we typically give a guideline of like a week to hear back from the application team, and then we bring you in for intake. And intake's just kind of confirming the information that that you would have provided us during your application, and within that process, I would say another week. So frankly, those are kind of long expectations. Should typically happen a little earlier, but capacity does change pretty drastically based on what else we're doing. Different teams
Thank
are
you.
doing.
Thanks.
So I would advise anyone, check out startsmallthinkbig.org. If you could use this help, you can't afford paying for someone else to do this in the private market, reach out to us. And you can reach out to me at financial@startsmallthinkbig.org, but I'm probably going to direct that over to the application and intake team. And you'll be able to reach out to them through the application process on our website as well.
Okay, so does anyone have any question? If you don't have any question, we will end the presentation here. Thank you everyone for joining us, and thank you Ian and Elaine. See you next time.
Okay, thank you. Have a great one.
Thanks, everyone.
Thank you, everyone.
Thank you.